Investing for beginners. How to start building wealth. Many people aim to become wealthy, yet doing so can frequently seem like an impossible undertaking. Avoid being seduced by get-rich-quick schemes and possibilities that seem too good to be true because they could lead you down a perilous path, because achieving this objective requires patience, perseverance, and discipline. The good news is that anyone can build and maintain money over time by using certain ideas and tactics. Additionally, your odds of success are increased the earlier you begin using these. We've listed several important wealth building guidelines below, including establishing goals and creating a strategy, investing in education and skills, managing debt, saving money, investing it, safeguarding your assets, comprehending the effects of taxes, and establishing a solid credit history. Each of these principles will be discussed in more detail in this article, along with how they might assist you in reaching your financial objectives. Number 5. Automate your saving process. Life is hectic. Maybe you are alert. Therefore, you must confirm that contributions to your retirement account are made automatically, because you are aware that any must do this now activity that suddenly pops into your head, like paying your credit card bill or watching the puppy video, will seem much more urgent at the time than saving money for some future date decades away. No matter what is going on in your life or the globe, you want your money to be quietly working for you in the background. Automatic savings are useful in this situation. Hey, with your 401k, you've already nailed this. You can replicate that procedure with your IRA by doing some preliminary work. Set up recurring transfers from your bank account to your IRA account. At some businesses, employees can have a portion of each paycheck automatically sent to their IRA. Find out if it is a benefit offered by your employer. You get to think less about your retirement account thanks to automatic saving strategies. You might wonder why it's advantageous to ignore your account. Because you don't want your hands anywhere near the sell button when the market is collapsing and your account balance is moving lower. Investing in equities requires the ability to weather the storms, and automating your savings can help. In addition, watching a few dog videos is a terrific way to pass the time during stock market falls. Number 4. Check on your investments once a year. As we've been saying, it's quite acceptable to let your money sit there and silently take in the highs and survive the lows of the financial markets when you're investing for a date many years in the future. However, it's also true that you shouldn't completely disregard your account. This is why your initial asset allocation, or how you divided up your money across various stocks and bonds, will fluctuate as a result of the market's gains and losses, and it will eventually fall out of whack. Say, for illustration, that you choose to invest 70% of your account in stocks and 30% in bonds when you first started it. If the value of the stock market has since improved, the percentage of your stock investments will increase. Perhaps 80% of your holdings are now equities. Your investment account would be riskier now compared to when you initially started building your retirement portfolio, since bonds are a more conservative investment than stocks. They have less potential for growth and less potential to collapse in value. You would be in for a rude awakening if the stock market crashed and 80% of your portfolio was made up of equities rather than the 70% you had initially selected. You must rebalance, which entails bringing your investments back to the initial percentages you decided upon, to lower that risk. However, if you invest in a target date fund, the fund manager will take care of the rebalancing for you. You don't need to do it. The same is true for many robo-advisors that rebalance your portfolio on their own. One of the benefits is that a temporary modification in your investment strategy, such as allocating a bigger portion of new account contributions to bonds for a while if your stock allocation has grown too heavy, is one way to rebalance your portfolio. The percentages you have invested in each asset class will gradually revert to where you wanted them when you add more money to your investments. Number 3. Increase your rate of saving. Did we mention how great it is that you are saving for your future? It's fantastic. And you've already completed the most difficult step, which is starting. The second step is simple. Increase your annual savings rate by a small amount. Because you can do it if and when your income increases. It is simple. Let's say you receive a raise, a bonus, or some unanticipated cash. Why not send a little of that to yourself in the future? Additionally, you always have the option of not doing it if the year is financially challenging. Your future financial stability may be significantly impacted by even modest improvements in your contribution rate. Recall how you have to rebalance your account once a year. See if you can't raise your savings rate by a tiny amount on that day every year. Or, for something even simpler, check to see if you can turn on annual auto increases in your 401k plan. If so, do it right now. Number 2. Keep costs low. Similar to how saving just a little bit more each year might increase your retirement savings, seemingly insignificant fees can have the reverse impact and drain a significant portion of your account over your career. How can you ensure that funds instead go to your retirement lifestyle and not just any investment firm? Make sure you invest in inexpensive index mutual funds as one reliable strategy. What qualifies as low cost, you ask? The top 401k plans provide mutual funds with expense ratios as low as 0.2%, which is even better. A mutual fund with an expense ratio of 0.5% or less is a fair deal. Fees are very significant. Avoid skipping this. Maybe throw a cut the fees party with your friends? You would individually log into your IRA or 401k account, then select each investment summary page by clicking through. The expense ratio is the main fee to pay attention to. Do you know of any mutual funds with comparable investing goals and lower expense ratios? Think about it. The money you save on investing expenses will more than cover the cost of the wine you will undoubtedly need to pay guests to attend this party. Number 1. Continue to use the market. The stock market is your ally when pursuing an objective like retirement. That doesn't mean it can't be frightful. When the market crashes, it may be downright terrifying. And it will fail. It never fails. But it also constantly climbs back up. You invest in thousands of companies both domestically and abroad if you have a diversified portfolio, which you undoubtedly do. Avoiding the market is equivalent to declaring that most businesses would fail globally. We can all rationally agree that although many firms do fail, many more perform well, and new enterprises are continuously starting up. It's not surprising that many investors have this thought when the market is in the toilet. Well, I'll just get out of the stock market now, and get back in later when things are looking up. The problem is that it is impossible to predict when the market will turn around. Additionally, if you leave the market, even temporarily, you run the danger of missing out on a variety of rewards. Try saying, "This is the best sale ever, and I don't even have to get up off the couch or click away from," enter the name of whatever show you're currently binge watching, the next time the market declines. I'm currently purchasing new mutual fund shares at a quarter of what they cost during the market's peak thanks to those recurring transfers I make from my paycheck to my retirement accounts. I'll have a lot more shares than before when the market does come around, as I know it will, and they'll all be worth more money. Keep in mind that building wealth typically takes time and perseverance. This is especially true if you want to pass assets down to future generations to create generational wealth. Even if you don't have much money to begin with, you may still start developing wealth because you don't need a lot of money to do so. Do you like it? Kindly give your valuable response in our comments section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.